All right, let's start something. We're going to continue from where we stopped yesterday. We're talking about um, types of candlestick patterns. Can you guys see my screen? Can you guys see my screen? Are you with me?
Yeah, we can see your screen. Yeah, we can see your screen.
Okay, fine. And like as I said during the WhatsApp live call, what forex trade is not for everyone. So if they aren't ready, serious to learn, it's on them. Okay. Um, this, what is that? Well, all right. So yesterday we were talking about types of candlestick pattern, and we stopped at hammer, right? We stopped at hammer. So now, hope you guys can hear me. Are you guys with me?
Yes.
Okay,
Yes, I can hear you.
okay, very well. So we're talking about types of candlestick patterns, right? So we talk about the hammer. The hammer is it shows a price reversal. Once you see a hammer, it tells you that okay, price is going to reverse from this point. So if the trend was bullish, it's going to turn bearish. If it was bearish, it's going to turn bullish. I explained all these trading terms for you guys, right? So now moving forward, we have the inverse hammer or the inverted hammer. It's still the inverse hammer and the inverted hammer is just it plays the same role. I showed you guys how it looks like. This is it. This is the diagram on the chart. I showed you guys on the chart. Let me check if I'm going to see here. Hammer, inverse hammer. Okay. Um, I'm trying to look for it at a significant. Okay, this hammer. This is a hammer here. This this guy here. That guy there. This is a hammer. Though the body is still big, we have still have okay. This is the hammer here. This is the inverse hammer. Inverse hammer here. That's it. Can see there. Right? This one. That's the inverse hammer. Then you have the regular hammer, which is this guy. Where is he? Let me find one. And these are hammers. We have two hammers here. One, two. Can even add this one. This is an inverse hammer too also. And this one must look more like inverse, but still a hammer. Right? So have them there. What do they represent? Price going to reverse at that certain point. Something something's going to happen at that certain point, right? But let's say like, okay, let me not go further deep yet, but that's the function of a hammer. Function of a hammer, it shows you price placement, telling you that indicates showing an indication that price is going to reverse from this place. Just like what happened here. This is a hammer, there's a hammer here. You can see this hammer here. So immediately the price was bullish from here. It came up here. Then what do you see there? You see there's a hammer here, right? You can see a hammer here. So that hammer, what made that hammer appear? The next thing, price started going down, right? So hammer is a shows uh, price reversal, market reversal, strategic points at key points, not at every instance, but strategic points. So going to the next candlestick pattern is the bullish engulfing. This is the one I like. I love using, and it appears majority of the time in trading. Majority of the time, all of them appear, but bullish engulfing appears majority of the time, right? So the bullish engulfing is a pattern formed of two candlesticks, right? The first candle is a short red body that is completely engulfed by the larger green candle. Though the second though the second day opens lower than the first, the bullish market pushes the price up, accumulating an obvious win for buyers. Right? So in appearance, this pattern is made up of two candlesticks occurring at the bottom of a downtrend. The first one is bearish, that's the red candle, while the second is green, and the green one is the one that engulfs the other one, right? In other words, the second candle's body is bigger than the previous one. There should be a gap between the close and the opening price. However, the gap is rarely seen in forex markets, but it's still seen. Indications of this pattern indicates increasing buying pressure and the beginning of an uptrend as the buyers will likely to drive price. So when I'm talking about a bullish engulfing, this is a bullish engulfing. Now, I hope you guys are seeing me. This red candle here, hence the name engulfing. This candle engulfs this one. Just like, let's say you have two-story buildings, right? The first story building is the red one, and that story building is two floors. Then the green candle is like six floors, right? So this one that is six floors is higher than this other one, so it's to engulf this other one, right? Hence the name bullish engulfing. So hence the name bullish engulfing is a bullish candle engulfing a bearish candle. Let's go to the chart. It's easy to spot. A bullish candle engulfing a bearish what candle. So like this, I don't even spot like 6, 7, 8, 9, 10, 11, 12, 13, 14. Let me mark them out for you. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, and 13. You guys should hold on, please. All right, sorry guys. Sorry. Okay, I'm back. So, um, I've marked bullish engulfings. So now, what do you see in this bullish engulfing? What do you notice? This is a bearish candle. That's a bearish candle there, right? Then what happens? This bullish candle engulfs this bearish candle. Now note, for it to be called a bullish engulfing, it should be a bullish candle engulfing the bearish candle. Hence the name bullish engulfing. Then it should be it should close above the open of the bearish candle. Where is the open of this bearish candle? See the open here. That's the open of this particular bearish candle. See where the open is here. Let me it should close above this, right? So here you can see all the candles are marked. They did the same thing. This guy here too did the same thing. This guy over here too did the same thing. I'm going to give you guys an assignment. You guys who okay. That I think that assignment is too early. But hence look at this is a bullish engulfing. This is a bullish engulfing. This is a bullish engulfing. Have you seen? Hope you can spot what happens. This bullish candle engulfs this small candle, the bearish candle. This bullish candle engulfs this bearish candle, right? Okay, okay. So that's that. So meeting this candlestick pattern at a strategic point. Where the strategic points, like here, see the way price reacted. Market was selling all the way from here. Or the market was selling from here down. The next thing you have a bullish engulfing. The next thing market goes up. Market was selling here. The next thing over here you have a bullish engulfing. It goes up small. Market is selling. The next thing there's a bullish engulfing somewhere there. So you can see that market respects the candlestick pattern. So using the candlestick pattern, use it as you can use the candlestick pattern as confirmation, as you can also use as an exit strategy and etc. Right? So this is what the bullish engulfing looks like. Okay, then so after the bullish engulfing, we have the piercing line. The piercing line The pressing line is also a two-stick pattern made up of a long red candle followed by a long green candle, right? The appearance, the pressing line is a pattern made up of a long bearish red candle followed by a long green candle occurring at the bottom of a downtrend. There is a gap down between the close and the opening prices, with the closing of the second candle more than halfway up of the bearish candle's body, right? So now indications. The beginning of this period looks bearish. However, the buy pressure increases throughout the candle, a, indicating the bulls are interested in the current price. So this candle pattern is more likely. How am I going to let me I don't really use that pattern, but it's rare. You rarely see it in the market. You rarely see that piercing line, but you use it for continuation. This is it. Use it for continuation. This is it. This is the piercing line. This guy here. One. That's it. Then though that one is not really. Where is it? Where is it? Where is it? Where is it? Yeah, you. Um, you rarely see it, but once you see it, it indicates price continuation. If market was bearish, it indicates price continuation. Like this, market was bullish, it indicated price will still go up from here, and price actually did went up from here. So that's it. Then I don't really use that one, but and I would advise not really to use it because it's kind of confusing. So if you want to focus on the candlestick pattern while trading, you focus on the hammer, you focus on the engulfing, you also focus on this guy, the morning star. The next candlestick pattern we're talking about is the morning star, right? The morning star is a candlestick pattern that is considered to be a sign of hope in the bleak market downtrend. It is a three candlestick pattern. One is short bodied candle between the long red and the long green candle. Traditionally, the star will have no overlap with the longer bodies and as the market gaps both on the open and close, right? So now the appearance, the morning star is a pattern made up of three different candles in the downtrend. The first, the long bearish candle. The second is the star, represents a long wick with short body that closes below the previous closing price. The third candle is a bullish candle that closes above the midpoint of the first. So what does it look like? This is what it looks like. So now, this morning star, it looks like, let's say you have an engulfing, but you have a different body close to the engulfing, right? This star indicates signal of a trend losing steam, often confirmed with the third candle launching an uptrend. So now let's move to the chart and let's find that guy. All right, see a morning star here. This is a perfect example of a morning star. Have you seen? Let me zoom in. Perfect example of a morning star, right? This is a star in between this guy with the here now the star. Then you have this is a bullish candle and then this is the bearish candle, right? So that's the star. Let's look for another star. This is a bullish engulfing, but this can also use as a star if you're adding this guy. It looks like what you have over here, right? Then you have another star here. Where is the star? This is the star in the middle here. This guy is a star. This is a bullish candle. This is the bullish candle. This is the star. This is the bullish candle. Then this is the bearish candle, right? So this looks like this here. This is like what we have here. I see it here, here. So when you see this guy, you should expect that market has started losing steam. Expect that market is going to surge to the upside, right? So then we have another candlestick pattern. We have the three white soldiers. Three white soldiers. I don't really use this candlestick pattern, but it comes out just like the hammer, the engulfing, and the morning star are candlestick patterns that mostly they come out back to back, so you really see them. Three white soldiers also come out back to back, but you need to really spot them. You need to be sensitive enough to notice them. They might not show the the way we see them on the textbook, the Bible how would I put it? The Bible doctrine way of how you should say three white soldiers, right? The textbook way, and put it that way. So hope I'm not muted. Okay. So the three white soldiers, this is a pattern. This these are three white soldiers pattern called over 3 days. Mostly the effective on the daily time frame, but most people trade them on the 15 minutes, 1 hour, 4 hours, whatever time frame they want to trade them on. It consists of consecutive long or green candles with small wicks, which open and close progressively higher than the previous day, right? So now the appearance. The three white soldier patterns consist of three bullish candles, green candles inside of a downtrend. The second and the third candles open with the body of the previous one and closing above it. The candles usually have little to lower wicks, right? This pattern indicates a strong buying pressure which drives the price up and even indicates an upcoming price reversal. The bigger the candles are, the stronger the pressure is. It's very strong. So it's a very strong bullish signal that occurs after a downtrend shows steady after a downtrend and shows steady advance of buying pressure. So what's the um three soldiers? This is it. This is what it looks like. Abi? The three white soldiers. Yeah, this is what it looks like. So the three white soldier is part of a bullish candlestick pattern. Remember, in this candlestick pattern, we have the bullish candlestick pattern and the bearish candlestick pattern. Inside the bullish candlestick pattern, you have bullish engulfing, you have hammer and inverted hammer, then we have morning star, then you have the three white soldiers, right? Hope you guys are following up. These are the three white soldiers. So let's go to the chart and check. Three white soldiers out. Wow, see them. I'll go to the 1 hour. They are common there, also common on the daily time frame. Okay, to why now? Okay, spotted one. Okay, it's more of like an evening star, but more of like a three white soldier. So you have them here. This is see them, right? You have one, you have two, you have three. Now, have you seen once market reached that level, this key point, and you saw the three white soldiers? What happened? From there, from there, you market buy. What did you buy? Where did you buy to? You bought till this point. Oh, you're going to keep your SL below here. Then where did you buy to? You bought. Come and take out this guy here. Have you seen that? That's a three white soldier. Let me spot. Let me try and see if I can spot another one. I rarely use it, but it mostly appears in crypto also. Yeah, if you're also trading, if you're trading crypto, but I don't. It appears. I'm looking for if I can find another three white soldiers. Go to 15 minutes time frame. I could use this one, but this guy is not. This guy looks like an Indonesian inverted hammer. Okay, I take this as three white soldiers also, but to this point where then they don't even make sense. One, two, three. And when market came, what did he came? What did he came back to feel the imbalance at the middle guy? Then from there, where the market go to, went all the way to the top. So this is a three white shoulder. I came back to test it. The next thing, boom, market went to the upside, broke structure before descended. Right? So that's example of the three white soldier. So let's move forward. So now bearish candlestick pattern. Bearish candlestick patterns. There are bearish candlestick patterns now, right? Bearish candlestick patterns are usually form after usually form after uptrend and usually form after an uptrend and a signal point of resistance. Heavy permission about the market price often causes traders to close their long positions and open a short position to take advantage of the falling price. So now different types, I mean the types of candlestick patterns of the bearish candlestick patterns. Remember, we have candlestick patterns. In the candlestick patterns, we have two types of candlestick patterns, which are like two categories of candlestick patterns, which are the bearish and the bullish. So inside the bullish candlestick patterns, we have the bullish engulfing, we have the morning star, we have the three white soldiers, and we also have the piercing line. And which other one do we have again? Morning star, piercing line, bullish engulfing, three white soldiers. Okay. Then the bearish candlestick patterns, we have the hanging man. The hanging man. The hanging man is a bearish equivalent of the hammer. So the hanging man is just an equivalent of the hammer, but the only thing is that it's now the hammer for the hammer it has to be a bullish candle. That is bullish candle means to a green candle. Instead of this candle being red, it has to be a green candle. But for the hanging man, it has to be red. So you guys know how a hammer is now. I showed you guys. So instead of the hammer to be bullish, that is green, to now be red. So once it's red, call it hanging man. But for me, all these ones are just terms. Once you see a hammer or once you just see a hammer, just know say even if it's bullish or bearish, just know say price at that point is going to reverse. If market was bearish, just know say it go reverse to be bullish. If it was bullish, just say it go reverse to be bearish. And not just seeing this hammer at any point, see it at strategic points, either at a support zone or a support zone or a resistance zone, right? So moving to the shooting star. The shooting star, I think it's the shooting star is still the same thing as hammer now. All of them are still almost the same thing. Shooting star, remember, in the hammer, you have the inverted hammer, inverse hammer, and the normal hammer, which is the normal hammer, they like this. Then the inverted hammer come there like this. And this one is still shooting star, but it's a red candle. So all of them just get the same thing. Just what all they just did, they change the name and they change. Can you hear me? Someone's asked a question. Hello. Okay. Thought someone wants to ask a question. Let me. All right. So now bearish engulfing. Bearish engulfing is the inverse of bullish engulfing. So what is bullish engulfing? Bullish engulfing is a bullish candle. Let me go back there. Bullish engulfing, look at it here. Bullish engulfing, right? Bullish engulfing is a bearish candle being engulfed by a bullish candle. Now, in bearish engulfing is a bullish candle being engulfed by a bearish candle. Hope I no confusing now. But this is it. Let me go to the chat. Make you understand that well. Now, remember I told you guys for us to say there is a bullish engulfing, right? This guy, man, zoom in well. I go see him well. All right. So now this is the bullish engulfing, right? This is the bullish candle. That guy is a bullish candle. We engulf this bearish candle. So what do you mean? He engulfed this guy. He engulfed that guy, right? So now let's imagine this guy, this bearish candle here is like two-story building. Then this green candle, I for me my candle I color them purple. So this purple candle is the bullish candle. The green candle is like six-story building. So he engulfed this guy, right? So hence the name. This bullish candle engulfed this bearish candle. Hence the name bullish engulfing. Bullish engulfing. So now vice versa. For a bearish engulfing, simple ideology, common sense, it should be a bearish candle engulfing a bullish candle. So now, let me show you bearish engulfing. This is a bearish engulfing, but it's not at this point. It doesn't really mean anything, anything significant. But this is a bearish engulfing. Look at it. This is a bearish candle. This is a bearish candle engulfing a bullish candle, right? So you see, this guy, this bearish candle long like this, close here. This is the opening price. He sell, then close here. He engulf this guy, bearish engulfing. Let me look for a bearish engulfing at a strategic point where you can see how market respects the bearish engulfing. Okay. This guy is too long. Okay, just like, but this, pick it from here. I've seen we have one bearish engulfing, two, three, four, five. I hope you guys can see them. Have you seen bearish candle engulf the bullish one, bearish candle engulf the bullish one, bearish candle engulf the bullish one. Over here, bearish candle here engulf the bullish one, bearish candle engulf the bullish one. Just beside this one self is the what? The bullish engulfing. This one, the bullish candle engulf this bearish candle, right? So hope you guys understand that. So the same function shows but this one shows since a bearish engulfing. What does it show you? It shows you that okay, price is going to start going down. Bullish engulfing has the name bullish. Bullish means market is going up. Buyers are taking over. Buyers are taking over. So when you see a bullish engulfing, it shows you that market is going to start going up at the strategic point. When you see a bearish engulfing, it shows that market will start going down at the strategic point, right? Now let's go to evening star. Everything, all these things are just candlestick pattern in the bearish side is just the inverse of the bullish side. So you have in the bullish side you have the morning star. Now in the bearish side you have the evening star. So look at the evening star here. It's just the same thing as the morning star. Look at it now. Look that they turn the thing upside down. Hope you guys understand it. Just turn it upside down. Now let's go to the chart. Where's that? There's a place I marked. Okay. Let me look for morning star. Then I don't know, but if any of you took this trade that I dropped on the Telegram, you should be in profits by now. Still holding the trade though, but market is a bit slow. I don't know what happened, but market, I don't. I'll check the economic event that's happening, but I don't understand why market is very very slow these days. So where is I marked an this is where I marked an evening star now. I'm looking for that guy. Is he here? I think it should be around here. Oh, you see everywhere bullish engulfing, bearish engulfing. Now I told you bearish engulfing, hammer. You see hammer. Those ones you go easily find them. All these evening stars, they happen, but see bearish. This is a bearish engulfing. They happen, but it's not really that common. See how they just define. Okay, why is this one self? Let me look. Let me look no more. I was looking for it at the strategy point. Let me use this one. Okay, yeah. Have you seen this candle? Like this is the star here. That's the bearish candle. This is the star here, and this is the bullish candle that I got with. So now this is the morning star. So now if I should flip this guy upside down, if I should flip this same guy like this, flip him upside down. Have you seen it has turned to evening star? Sorry about that. Turn to evening star. Let me look for an accurate evening star for you. So that's cool. All right. No, this guy is not. I see bearish engulfing, right? Bearish engulfing here. Still looking for an evening star. Bearish engulfing. Okay, see an evening star here. Though just beside is a bullish engulfing. If you want to mark from here, like this, you have this. See, this is a bullish engulfing. But from here now, evening star, right? So now, what makes up this evening star? You have the star in the middle, which is this guy. Then you have the bullish candle. Then you have the bearish candle where long come cover and cover two of them, like kind of engulf two of them. You see, this one will be like 3-story building. This one will be like 1 story. This one will be like 7-story building. Evening star, hence the name, right? So it's just like an inverse of. I told you guys the candlestick patterns, the bearish candlestick pattern is just like an inverse of what you have on the bullish candlestick patterns. All right. So the three black. Remember, we have the three white soldiers. So we now have the three black crows on the bearish. So it's just the same thing. Three bearish candle. Just the shows the price they go down. Let me see if I could see that one safe. That one was the. Okay, something like this. This guy. You have one, two, two, three. Take the sell. Keep your stop loss here. Where are you targeting? Where are you targeting? Next break of structure here. Okay. So zooming in, what do we have here? the three what black crows. So the three black crows is just an inverse of the three white soldiers. Remember, the three white soldiers forbid three bullish candles, but now the three black crows now are bearish candles. One, two, three bearish candles as a candlestick confirmation, candlestick pattern. You know, so enter your trade, execute your trade, and there you go. Market sold, even continue to sell, go down, sell, can't reach here, right? But it's a good candlestick pattern you can use as a confirmation and also as an exit confirmation. So I wrote the indications here. They are the same thing, both scenarios. Just that whatever. Now listen to me. Whatever the bullish candlestick pattern will do, whatever function, whatever appearance, whatever indications they make in the market will signify a bullish reaction. Whatever these bearish candles will do in the market will signify a bearish reaction. Do you understand? They're not the same thing, but wherever you see them, they are reacting. They are reacting either to be bearish or to be bullish. Okay. So now this is just showing you. Now this I'm just showing you guys the basics of the candle. I showed you guys already. The okay. This was a dark cloud cover. Sorry, dark cloud cover. This was just a textbook candlestick pattern. People rarely use it, and people rarely use it. It's just like FTR pattern. So I just attached it to the this so that you guys have fair knowledge about it. Only used for continuation. So we have continuation after the bearish and the bullish candlestick pattern. We have continuation candlestick patterns, which are the doji. You have the doji, which is this guy. They have the spinning top, which is this guy. Then we have the falling three method, which is this guy. So now, all these continuation patterns, I would advise you stick to the falling three methods, the falling and the rising three methods. Now, what's mostly there is this. This is it. The falling three method is just like identifying the three white soldiers or the three black crows. This is it. Falling three methods, right? The falling three methods, then the rising whatever. This is even still an example of three three what did they call it? Three white soldiers. But now one thing, yeah, get this right. All these candlestick patterns, you can identify them at any place of the market. But what makes them significant? What makes them useful? What makes them function in their duty, which they are known for, is finding them at key points where they respect market analysis or market structure. That is, I mean, for this beginners course, I don't even talk to this one as they talk for beginners course. That is, this bearish engulfing where you see here, whatever, you should not be looking for a bearish engulfing mid. You should be looking for a bearish engulfing mid here. You should be looking for bearish engulfing at a key point like here. Like here now. Think this is a breaker. There's a breaker block there. So market came to respect that place, and market was still bouncing up. Let's say see your bearish engulfing, you execute trade. There's no how that this bearish engulfing will fail, and you see market sell down to this point, right? Now this way you still see this bearish engulfing, market no go one sell, market will still buy. Like here, see the bearish engulfing day here. See I'm here. See the bearish engulfing there. Market no go sell, he buy. At that point you say, oh, this thing no dey work. Oh, this guy teach no dey work. See bearish engulfing there again. But wetin happen? The guy no gree sell. E still dey go up. E take you out. You hit running losses. So you need to find them at strategic points. If not, they are easy to identify. You will see them implemented everywhere in the market. But the only way they can perform their specific function is if you find them at strategic points, which they are keen to respect. So that's that for that as far as that is concerned. So you guys can read through. Remember, your brain gets stronger every day because you exercise. The stronger it gets, the more money you can make. All right. So let's talk about this is 10:14. I started today's class late, so let's say 10:30. I'll stop by 10:30. Let me talk about the difference between TA and FA. So now, what is okay? The difference between trading and investing, right? There's a huge difference between trading and investing. Now, in the sense that as an investor, hold on. Okay, sorry. All right, as an investor, right, you're aiming to take in. That's why they consider hedge funds as mostly investments. They take millions of dollars of capital from clients to trade for them. So now, as an investor, you're taking long-term positions on digital assets or currency pairs. So mostly people that are investing in Forex, they mostly tend to take long-term positions like the swing position. They can take a trade and swing the trade. So it's mostly like investing, like you're growing your capital, right? Like um you're taking I'm trying to look for the right word, but okay. You're taking positions. Okay, let me put it okay, let's say crypto now. Investor, you're buying and holding and keeping like buying and keeping your crypto wallet, whatever. Something like Forex, you're buying a currency pair with with huge lot size, but you're not hoping on cashing out anytime soon. You're not hoping on being stopped out anytime soon. You're holding and riding down for the long run, right? And you're looking at making 30% of whatever you invested on that position. But whereas trading is you, right? Making aiming for short term profit based on technical analysis. I think I wrote that trading in the forex market is aiming for short term profit based on technical analysis and short term trends. While investing is aiming to create long-term positions in digital assets based on fundamental analysis without interest. So when you're investing in forex, you're looking at the economics, you're looking at fundamental analysis. While trading, you're looking at the short-term side, which is the TA. But now, mind you, the TA and FA work together. Having meshed both of them together will give you um, an edge, give you a good exit plan when trading, right? So let me read this out for you. Attempting to buy at low high. All these were just explanations. Everything now. But let me read it out, sure. Attempting to buy low and sell high in a short term, you would be willing to take losses or set stops. You often end up buying high and selling a bit lower when it tends to turn against you. You will buy high and follow the trend, then get out if you need. In fact, the current price alone means very little. What you care about is the potential for your percentage gain. You are thinking about the setup and the room the price has to increase and decrease in a short term. You leave money on the table all the time because your goal is profit, capital preservation, and capital growth. So this is just telling you that as it trading, you're looking at gains. You leave money on the table, right? Leave money on the table. There are sometimes when you trade. hasn't really gone in profit as you projected, like as you speculated, as your analysis was, or you closed the trade, you took partials, or you closed the trade, maybe you saw something, or maybe say you were just like, okay, I've made this profit, let me just close first, anyhow we market will do, or might just secure this profit. But while in investment, they don't really do that. They allow the trade to run to its full potentials, right? They allow it to run to its limit till you are aware of the market no go fit go again. Hence, just like taking a trade from an order block to the next break of structure, taking the trade from the other block to the next break of structure, you know that the next break of structure, after the break of structure, you should be expecting reversals. So hence, that's the end of that long run, that bull run, or wherever. Do you get me? So while in aiming to create long-term positions in digital assets based on the fundamental analysis, based on the analysis where you don't hear from news on the economy of those currency pairs. I tell you to create a position within lower price, then price will eventually sell down sell at down the road. If you plan to sell at all, lots of room to mistime buyers. Very little selling, although one may hedge to help manage their positions. For example, trading some selling, some high and rebuying, or holding a short position against larger positions. So what that simply means is just like investing is like, why I want to use crypto because it's simpler for you guys to understand than currency pairs. It's like buying Bitcoin. Then let's say you buy Bitcoin for a long run till, let's say, when Bitcoin was $10,000 per Bitcoin, you buy like 20 Bitcoins, or let's say 40. Then while Bitcoin is increasing in price, you withdrew some, use those money, the profit, buy again, then you now withdraw capital again, bought other coins. Then as the coins are progressing, you're withdrawing and buying more of those coins, those same coins that are progressing, that investment. So in Forex too, that happens, hedging too happens. That's what hedge funds do also. So they hedge. So that's simply the difference between trading and investing. So you guys can read through. I explained everything in details on the PDFs. All right. So, let me the argument on FA and TA. If I should take this, what else will remain on this thing? Okay, let me leave this for tomorrow. I'll summarize this argument on FA and TA and what again? I think there's one other material left for the beginners class to be done. All right. So, you guys should note, I also said Forex is not for everyone. If you want to join the intermediate class, once you join the intermediate class, you'll be the other things you guys will need to know: analysis, how to make analysis, top down analysis, MTFA, FTR, all those things. There are several things that will go on the intermediate class. So the beginner class was just an eye opener. You guys can understand the basic things about Forex and how the market moves. So getting access to the intermediate class will give you 50% off for the advanced class. So if you're interested after this, after the beginners class, you can DM me and we'll progress. All right. So hope there's no questions. Any questions? Any questions? All right. There's no questions. So do have a good night. Thank you guys for joining, and always try your best to, at the end of every video, reread what was taught, reread the materials, and try to go and see if you can identify some of the things that were taught, right? So this one, okay, I haven't dropped the apps when we use. I'll drop the apps we use on the WhatsApp group chat so that you guys can scale up. Though that's the last part of the beginners course which I'm supposed to teach. I can do that before then. So you do have a good evening and See you guys tomorrow. Bye bye.